My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make you a little money. My job is not just entertain, but put it all in context. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Today, yes, was all about the Middle East, about Iran firing waves of ballistic missiles at Israel, something that naturally did hurt the market, with the Dow dipping 173 points, S&P sinking 0.93%, and the Nasdaq tumbling 1.53%. But despite the geopolitical turmoil, which I never want to downplay to you, tonight I want to spend some time celebrating the quarter just passed, because a remarkable thing happened. When you look at the 10 best performers of the third quarter, we discover that this formerly narrow market has totally changed its stripes. I pride myself on knowing tons of stocks. You know that. I really try to understand and be my own chat GPT. But the winners this quarter taxed every microprocessor implanted in my little head. No FANG, no Magnificent Seven. It was like Robert Altman's The Player. No Bruce Willis, no Julia Roberts. So rather than dwelling on the possibility that this regional war in the Middle East keeps escalating, I want to do something constructive tonight. Focus on how we've finally gotten a real broadening out of the market's leadership that we've all wanted and that so many call for. This was the quarter where we got the revenge of the little guy companies, the ones you rarely hear about outside, of course, our lightning round. That's why I want to highlight the S&P 500's 10 best performers in the third quarter, and we're going to do them in ascending order. Now, this list is pretty much devoid of barn burners, which is why I do like it so much. These are companies that not only can you sleep at night with, they actually may put you to sleep. Fortunately, the 10th best isn't one of them. Axon Enterprise. That's the company that makes tasers, body cameras for law enforcement, as well as a digital evidence management business that helps keep track of all police records. Axon stock has been red hot for ages. So it's no surprise at all that it rallied another 35.8% in the third quarter. Seems strange that we don't talk about this stock more, but it's very much part of the broadening of the winners column. The ninth best performer, fortunately, hits close to home. It's Stanley Black & Decker, which is a big position for the Charitable Trust. Why? Because we wanted to invest in a company that tends to outperform when mortgage rates go lower and people fix up their homes. After years of lagging the market, Stanley Black & Decker has come back with a vengeance, up 37.9% in the third quarter. It was rallying in anticipation of the rate cuts. Do you know that the big growth's not even there yet? But I bet it can keep running. Number 8 is Vistra. Now, this is a power company with a key nuclear station called Comanche Peak Nuclear Power Plant. That includes 2 nuclear reactors. We've seen this insatiable demand for clean energy for data centers and the hyperscalers that use them. It's exploded to the point where Microsoft's getting one of the reactors in 3 Mile Island to reopen. Not the one that had the meltdown. So Vistra was up 37.9% for the quarter. It's now up 218% for the year. Hard to imagine a boring old utility making that kind of move, but carbon-free electricity has become one of the hottest commodities out there, and taking up a whole bunch of stocks, and Vistra's front and center. You always see Constellation Energy in that group, too. Number 7. All right, we've gotten used to people coming on air and warning us about the looming demise of commercial real estate. Well, someone better tell the people at CBRE, which does everything from commercial real estate advisory and transactional services to valuation and property management. The fact that this stock could be up almost 40% for the quarter tells me maybe we should think twice before being so negative on commercial real estate. They know nothing! 6. You're always going to get a takeover in the top 10. But this one really came out of left field. Kellanova, the snack food company created when the old Kellogg broke itself up, it's being bought by the privately held Mars for a huge $35.9 billion price tag. Now, almost no one saw this one coming because we're constantly being told that snacks are a dying category thanks to the GLP-1 weight loss drugs. Mars clearly doesn't think so, and nobody knows junk food better than they do. And that's why the stock of Kellanova was up almost 40%. 5th, you and I, we think of Home Depot, another charitable trust name, as being the place for professionals to buy the products. They need to put up new houses, renovate old ones. But the pure play housing supplier for the pros is actually Builders First Source, a niche wholesaler that we've featured on the show repeatedly. Stock was up 40.1% in the quarter. Again, you cannot wait for Builders First Source to put up big numbers before you buy it. This is an obvious rate cut winner, so you got to get in ahead of time. In this business, anticipation cannot make you wait. When you think about what goes into construction, flooring is clearly a necessity, and flooring is synonymous with a company called Mohawk Industries, the king of carpet, hardwood, and vinyl flooring, not to mention pretty much everything else you step on. Mohawk's a natural buy in a rate cut cycle, which is why the stock jumped 41.5% last quarter. And again, this is well ahead of any turn in earnings. Number 3, Palantir Technologies is a data analytics company that put up some good numbers, but it's better known as a stock with a huge following among individual investors. Stoked by its flamboyant CEO, Alex Carr. Now, a little more than 2 weeks ago, the Wall Street Journal published this incredible piece, headline, quote, "The fanatic amateur investors behind Palantir," end quote, which gave some great insight into the avid fan base that rejoiced when the stock joined the S&P 500 last month. You know, they came in on top of the admission and helped the stock soar 46.9% for the quarter. Next, it wasn't that long ago that many of us were fretting about General Electric's power division, that the company spun off as GE Vernova as part of its bid to become a pure play on aerospace. I know I asked GE Aerospace CEO Larry Culp, he's the mastermind of the breakup, how confident was he in the credit rating for the power business, which includes the building of natural gas plants, windmills, nuclear power. Turns out GE Vernova had nothing to worry about. In fact, the spinoff came at the perfect time. Stock was a home run, zooming 48.7% in the third quarter as power generation has become a phenomenal growth story. Ugly duckling into dynamite squad. Finally, you went broad. How about a company that manages an insurance exchange for people who want to buy policies? And it's called Erie Indemnity. That's Lake Erie. Now, that was the best performer in the entire S&P. It's up 49%. Now, a lot of that had to do with the stock's admission to the index, which brought in a slew of automatic buyers. But, man, Erie Indemnity managed the Erie Insurance Exchange. $10 billion in premiums, around 7 million policies in force. And when the Fed cuts rates, the insurance companies go wild. This one's truly emblematic of the eclectic, non-tech group of winners that dominated the third quarter. Erie's success is eerie. Here's the bottom line. The next time you hear that this market's made up of just a few cloistered winners, I need you to remember this list I just went over. The recent rally is all about companies that you haven't heard of, or maybe a little word of mouth about, that benefit from lower interest rates or the endless need for power or security. It is a remarkable list that represents a real broadening out of the winners. Some would say it's a sign of where we're headed. I might not go that far, but clearly we need to start digging a lot deeper to find winners going forward. They're no longer as plain as the nose on your face or the tech in front of your eyes. Let's take some calls. Let's go to Frank in New York. Frank.
Welcome back, Jimbo.
Thanks
I love the
lot,
shows
Frank.
last week. Shows last week were great. Really
I am
learned a
so
lot.
glad. Thank you. That's Regina Gilgate, executive producer, puts those together, and it's really sensational. It means a lot to me to hear you say that, because I do need some time off periodically just to recharge the batteries. How can I help you?
You're the hardest working man in the business. Football teams are struggling right now, and at least it's baseball. Maybe a Phillies-Yankees World Series is on deck, I hope.
I'll take that. I'll take anything good from Philadelphia at this moment. What's happening?
So I have a question about Lyft. I use both Lyft and Uber as a customer, and right now I'm only using Lyft. They seem to have quicker pickup times, better prices. And I talked to their drivers, and the drivers also seem to be doing better with Lyft. They take care of them better.
Right.
I bought Lyft back in August. It's been on fire lately. The new CEO, he seems pretty sharp. No, you don't
I like David Risher very much, but I'll tell you something, Frank. As good as Lyft is, and I like David very much, you know, I've got to tell you, Uber is a juggernaut. They're doing so many things right. That's the one I do prefer in the group. Let's go to my home state of Pennsylvania. Keith in Pennsylvania. Keith.
Hey, Mr. Cramer, how you doing?
I am doing well, Keith. How about you?
Doing all right. Recovering from hernia surgery, so taking it.
Hey, I had a quadruple. Be very careful. I went right back and started lifting, and it was all wrong. Take your time. How can I help?
I appreciate that. Okay, so a few weeks ago, you had Elf CEO on there, and you seemed to be impressed with the stock, but it's still it consolidated and still on a leg down now. I guess with the ports closing, elites are on strike anyway, and with what's going on, do you suggest, what would you suggest a good price point would be for an entry point for Elf?
Well, candidly, I've liked Terramine so long that I kind of lost track of the fact that the group itself has become such a bear to own. I'm reluctant to say buy it yet because it is in free fall. And I find stocks in free fall We have to wait. They will tell us when to buy. It's when they bounce and not until then. All right, listen. The next time you hear that this market is made up only of a few winners, I need you to remember the list I just went over, please. It's a remarkable set of names that shows you just how broad the winners were in the third quarter, which was a sensational quarter. Now, I'm mad tonight. Chipotle's had some changes at the top following the former CEO's move to Starbucks. I'm taking a bite of the latest with the company's top brass. Then, McCormick reported a solid quarter this morning, sending the stock higher. So could the stock add some spice to your portfolio after these latest numbers? You do not want to miss my exclusive. And Signet CEO announced her plans to retire after successfully turning around the jewelry kingpin. Now, I'm hearing more about the transition with that terrific executive herself, so stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
When Starbucks poached Brian Niccol, the CEO of Chipotle, its stock shot up 24.5% on the news. But Chipotle stock tumbled 7.5% that same day. Brian's a great executive, but you know what? Chipotle's not a one-man show. This is a fantastic company with a deep bench. Don't take it from me. Earlier today, we checked in with Scott Boatwright, Chipotle's interim CEO, and Jack Hartung, the president and chief strategy officer. Take a look. Scott, I want to start with a real serious question. How long will the brisket be available?
Jim, it's a fantastic question. We'll have brisket at least through the end of the year, maybe a bit longer, depending on supply, but it's a product we're super excited about that is performing really well in the market today.
All right, well, you may think, if we've got Jack here, you may think that that's a facetious question, but what I'm really getting at is that there's no real difficult transition here. This is one of the smoothest, easiest. The stock drops 6.5% when it happens. Comes right back. Jack, isn't the secret of Chipotle the kind of horizontal, fabulous nature that you people all have? And there's just there's an ethos that we don't see at even the most winning of teams.
Yeah, Jim, totally true. You know, Chipotle's always had this purpose. Our purpose is to cultivate a better world. And the folks in this organization, and I'm talking about from the top, from Scott to me, to our leadership team, all the way down to the crew. We spent a lot of time in restaurants before we came here today. Right. Everyone believes in this purpose. And when you have the whole organization believing in that purpose, you can create some amazing things. And so we've got a lot of momentum behind us and a lot of opportunity in front of us.
All right, so Scott, tell us a little about yourself, because we haven't seen you on. Obviously, you're a person who's a part of this seamless transition, and we want to get to know you more.
I'd love that, and welcome the opportunity, Jim. Thank you. So I've been with the organization, leading the operations organization for over 7 years now, and have grown the brand from 2,300 restaurants to over 3,500 restaurants today. We have a world-class people organization that has really been driving and executing against our core strategies for the past several years that have served us exceptionally well. What I'm most excited about, Jim, is the future, where we're going. We're still in the early innings of what this brand is going to be, as we're on our path to 7,000 restaurants in North America and through international expansion.
Well, let's talk about that today. Dubai. It sounds terrific. First restaurant opening, it's second in that area, but it's franchise partnership.
It is.
That's something that I didn't expect from Chipotle.
It's our first license agreement, and it's with Al Shaya Group, which we're very happy with the partnership. We're in the early phases of that partnership today. We have 2 restaurants open in Kuwait. We open our first location in Dubai tomorrow, actually, in Jumeirah Beach.
Right. Now, that is very exciting, because I've always hoped, and I've said this to you guys for a long time, if it works in the United States all over, it's a natural overseas. But you guys have always been very considered, a little bit slow, Jack, I think. But tell me about the big worldwide expansion plans.
Yeah, so we think we've got big opportunity worldwide, Jim, but we've always been very protective of our brand. One reason why it took us a long time, we've had incoming requests for a franchise opportunity for at least a decade. We've gotten to know the Al Shaya Group for the last 3 or 4 years, and finally came to the conclusion, this is a world-class group, and they're doing a great job with our brand. In Europe, we've seeded the restaurants. We opened about 10 years ago or so. we didn't quite get the food dialed in, didn't quite get the supply chain dialed in. There were just little differences all along the way, and what we didn't want to do is build out the brand. This isn't about growing, just for growth's sake. We want the brand, the food, the experience to be fantastic before we grow. We're getting very, very close. Anat Davidson, who did a great job in Canada, now oversees Europe. They've made fantastic changes in the last 12 to 18 months, and I do predict that Europe is going to be a growth vehicle for us in the very near future.
That's sensational, because I don't think you're at all about to run out in the United States, but I love Chipotle. Our staff loves Chipotle. Everybody's watching with Chipotle. It seems to be a natural everywhere.
It's doing really well. I'll tell you, Jim, the U.S. business is on fire. We love what's happening up in Canada. We're going to grow Canada somewhere in the neighborhood of 25 to 35% this year.
Okay.
And that's going to continue to grow in that market over the coming years. But we're really excited about the Europe opportunity. We think under Anat's leadership, we're starting to move the needle, starting to really solve the economic challenge there. And we have a model we like, and we think we can grow that pretty aggressively over the next few years.
Okay, so Jack, you did highly unusual. You have a new CFO today. Adam, it's terrific that was your job. I thought that you were going to leave. Obviously, you're not happy with it, with just having any old transition. You come right back, new position. Are you going to continue with premium ingredients, affordable prices, and attractive margins?
God, I hope so, Jim. I've been talking about those three things for the last 20-something years. Yeah. And frankly, the fact that you remember it, and more important than that, our team remembers it. And we had our whole management team, our managers across all of our restaurants together back in March. And we talked about how special it is to have those three things, to have premium ingredients, affordable food, and attractive margins so we can keep reinvesting in our business. That's and as long as we take care of those three things and run great restaurants, which Scott and his team do a fantastic job, the future is very, very bright for us.
Yeah. All right, well, Scott, another thing that I love about Chipotle is when I meet with people who work at Chipotle, they're treated with dignity. They are people who look in the eye. They're people who are great spokespeople for Chipotle, but they're also people who often own stock. You have quietly, you don't talk about money, and I respect that, but we are in business, quietly created quite a few millionaires.
We have, through the years, Jim. It's pretty impressive what's transpired, especially over the last 7 years that I've been with the organization. We have gone from around 80,000 total employees to just over 120,000 today. And our team members are the absolute backbone of this great organization. Without them, we wouldn't enjoy the success we have today. We continue to lean into what we believe to be the best culture in the business, industry-leading benefits and wages, and development opportunities like no other.
Now, I would be wrong not to mention Brian, because Brian Nick, has such a great relation. He's so terrific. He got me to read this Co-Intelligence, because it was a book he talked about and suggested I read it. And this is about, to me, the most AI book I've ever read in terms of businesses learning how to integrate AI. You've done tremendous. And I'm not just talking about machines that are robots that work, but throughout, you've got basically a platform of AI. How's it going?
So it's early days, Jim, but it's going quite well. Here's the thing is we're going to bring technology to make the experience for our crews and the experience for our customers better. The thing we're not going to do is remove that personalization. There's still going to be that eye-to-eye contact. We're still going to serve you along the line so you get exactly what you want as a customer. But there are things behind the scenes, like way before our restaurants ever open, that are complicated tasks or time-consuming tasks. And if we can make those simpler for our crew, they're going to have a better experience. They're going to be happier by the time we open up the doors and customers come in, and the customers are going to have great experience as well. Now, a lot of this technology doesn't exist. It's not off the shelf. But that's okay. We're taking the long game here. Right. We're going to work with some outside partners and custom develop some of this innovation so that the entire experience for our crew is going to be better. And it includes things like avocado, which will cut core and peel the avocado. That device doesn't exist. We're creating it. Hyphen, which will make the bowl on our digital make line automatically so that our crew can spend time doing other things, including servicing the customers. So we're very excited, but it's early days. But we think that technology and AI in particular can be a big unlock for us.
Now, Scott, we've got things like dual grill mentioned, and I point these things out because throughput matters. We know that there are places that fail because the throughput's bad. You just guys seem like you're just not content with just being a great restaurant. You are a great restaurant that gets people through and happy. And by the way, that's also Chipotle, and this has been a hallmark of yours.
I think the value proposition at Chipotle is grounded in high-quality, great ingredients served in abundance at a speed at which you can't get anywhere else at an affordable price point. And so when you bundle those all those things together, you really create this incredible guest experience that drives customers back into our restaurants. Speed is important to our business. Our customers are very busy people. They're on the go with families or jobs or what have you, Jim. And so it's always been our imperative to move them through the process as quickly as possible. Leveraging automation allows us to deliver that experience even more efficiently and more fluidly. And again, to Jack's point, remove those mundane tasks that are so repetitive that team members just don't enjoy doing at all. And so we think we have a great plan for the future and how we execute it.
Excellent. Now, Jack, on that last call, you did talk about how you finally may have hit a point of resistance in California, at least. You can't just keep raising price. How do you feel about the consumer right now and how much they can absorb? And let's throw in the fact that I don't know about you guys, but my lunch, it's just too big. I'm having it as lunch and dinner. I feel it's a bargain, but I also am sense of the idea that there's a lot of people around the country who need a bargain.
So, Jim, we watch it really close throughout the country, and we continue to have really strong value scores. We get high scores for the amount of food for the money, the quality of food for the money. Frankly, our read on California is less about resistance to our price increase, and it's more of a macro impact. Because when you look at the restaurant industry, the restaurant transactions are down for everybody, and that it really doesn't matter whether you took a small increase, as some companies did, and a very large increase, as some companies did. We took an increase about in the middle, and pretty much across the board, there was a pullback from the consumer. So I think it's more of a macro resistance to inflation in general in California. But we watch that stuff very closely because it's the three things. It's, one of the three things is affordable. We're not going to give up on affordable because we don't want just some people to enjoy Chipotle. We want everyone to enjoy Chipotle.
Excellent. Well, I want to thank both of you. It's an honor to have you. Scott, this is a great chance to be able to talk. Jack, I'm so thrilled you stayed on. Even if maybe I think you might have wanted to do some other things, but you're here.
We need this guy, Jim.
We all do. All of your customers need him. That's Scott Boatwright. He's Chipotle's interim CEO, and Jack Hartung is President and Chief Strategy Officer. It is nothing but pure joy to have you on Mad Money. Thank you, Jim.
Thank you, Jim. Appreciate the time.
Coming up, give your investments a little kick? Cramer spices it up with a stock that brings the flavor. Next.
This morning we got results from McCormick, the leading maker of spices and seasonings. Once again, the number's pretty solid. McCormick has delivered a series of good quarters. The stock is now up 23% year-to-date, outperforming the S&P 500. Today we got more of the same. McCormick delivered better than expected sales, positive volume growth for the first time in nearly 3 years. We got to talk about that. Throw in some strong margins, and you get a 16-cent earnings beat off a 67-cent basis. On top of that, management raised their full-year sales and earnings forecast. No wonder the stock's splitting this as a 52-week high. It's almost there. So can it keep climbing? Let's check in with Brendan Foley. He's the CEO and President of McCormick. Get a better Rebus. Foley, welcome back to Mad Money.
Great to be here, Jim. Thank you.
This was the quarter I've been waiting for. This is the quarter of volume growth. How did it happen?
We called out 2024 as a year of investment back into our business, and we're really seeing great results from doing that. The third quarter was an important turnaround for us. We're growing total company volume, and a lot of it's because we got the right programs and investments in place.
Now, it also seems innovation, got a ton of it. There seems to be a undercurrent of Gen Z. People thought it got too expensive to go out. You were the antidote to that.
Consumers are looking for value, and we think we're doing the right things across our business to do that. Flavor is a small part of the cost of any meal, but it has such a big impact. And so we see a lot more consumers now shopping around the perimeter of the store. They're having to flavor a lot more of their meals because they're making it from the produce department or buying new steak, and they need Montreal steak to flavor their steak.
But you also have something going on that when I check in with people in the food business, there's kind of a odd cult about what you have. French's mustard. I want the mustard that my parents had. McCormick spice doesn't go bad. I love it. And then this crazy stuff where the social media for your stuff, which is not done by you, but is organic, is causing people to buy whatever they've got and they're selling out.
I think you're talking about our finishing sugars here.
Indeed.
We just came out with these. It's a really interesting insight in how we came up with this. We are testing flavors all the time online, and we're selling products to consumers, and then we ask them to kind of write back how they're using them. So we sold this English toffee, and we got feedback from consumers, and they're saying, well, I'm adding it into my coffee. And all of a sudden, we're like, wait a second. We're known for, kind of creating pumpkin, pie spice. And so we said, well, let's make a whole line around, finishing sugars that you can add to hot drinks. Perfect for the holidays, also perfect for baking. But, these things do take off, and we hit the right insight with consumers.
Now, is that just a lab or people you have who know what the future is bringing? How do you know?
This is the most important thing we do, is find trends, identify when they're going to start to mainstream, and then hit them, out in the marketplace. And that's what's happening with these finishing sugars. Same thing is true with authentic Mexican, with Cholula. And so this is part of our job, and we're always identifying new trends. That's what's fun about the flavor business, is it's always changing all the time.
All right, now what happens if I'm not sure? How about something like this, which seems to be pretty darn new?
Well, this is an interesting one. We're finding out that what's really working with consumers, particularly as they're thinking a lot more about their spending right now. They want to try new flavors. They do want to explore, but they may not want to spend as much as they would normally do. So they'll put out $1 to try a new flavor, and that's what we're finding is really working with these minis with Frank's. And so this is a small version of what we have up there. I love the creamy buffalo, and we're seeing a lot of turns from that.
All right, now we also know that there is margin improvement. Now that is not necessarily something that that someone who's in Gen Z would care about, but yes, the big trigger pullers in our business want to see margin improvement. It's pretty significant.
Well, across our business, what we're doing is we're putting a lot more investment back into the business,
right,
but we're also expanding margin at the same time. And, part of our productivity program really helps us deliver that. And, we really had a strong third quarter as a result of a lot of that activity.
Well, I've got to tell you, you're also something I've been struggling with the food group for a long time because of this GLP-1 issue. But you don't have any GLP-1 problems.
We have a portfolio that really appeals to everyone, whether you want to eat as healthy as you're trying to, or even if you want to make, a dish that, you really just savor and you love. Our product range really applies to any household, any cuisine, and that's the great part about our business. It's an ingredient-based business. It's all about flavor, and no one really sacrifices on flavor.
And also, if I go with Frank's or if we don't have it here with French's, I always say to myself, maybe I shouldn't, hey, no calories. But it's pretty darn close to no calories.
Oh, yeah, it is pretty good. Those are pretty healthy products. So is your French's mustard that you love.
Right.
Yeah.
What's funny, my daughter was saying, Dad, I like the French's because it's yellow like when I was growing up.
Yes, and it's naturally yellow.
Yes.
Yeah.
But there's, a kind of a belief that this is the brand that is in everybody's pantry and everybody's kitchen. The universality, and it doesn't just, it doesn't end in America either, does it?
No, a brand like French's and Frank's Red Hot goes global. So does Cholula. We're going to start to grow that brand at a global level. But these are brands that appeal to a wide variety of households. Either growing up with them, but these are brands that really, we think the country loves.
Now, I don't want to get too far ahead of myself, and I know you have a very important Investor Day meeting, but I've always felt that you don't get a company that triggers into some volume growth and then it goes back down. I like to be there at the inception. Am I wrong into thinking that it's okay to believe this could be some sort of fulcrum?
We see continued momentum in our business, Jim. And we've been investing in that momentum already, but there is still more growth ahead. In fact, we're not satisfied with the growth that we have right now. We're going after more, and it's going to be healthy volume-led growth.
And I understand that your e-commerce volume is really gangbusters right now.
It's doing well. And a big percentage of it keeps growing every year. People are looking for the convenience, whether it's omni-channel or pure play, retailers out there. People looking for the convenience, being able to buy online and then go pick it up. And we're seeing a lot of growth there. The key there for us is have really good content, meet the consumer with where they are, and just be available.
Are you out of any of these? Am I going to have trouble finding some of these in the store?
Well, this line, it went online just to kind of test the marketplace, and it sold out immediately. We're bringing them into stores this holiday season.
Well, congratulations to you. You've done the great expansion that we're looking for. You've always been known to be innovative, but everybody's kind of jazzed about McCormick right now. It's really terrific, and it's on you and your team. Fair enough? Thank you. That's Brendan Foley. He's the president and CEO of McCormick. Guys, you know this stuff. It's in your house. You know how I tell you to buy things that you know McCormick. And money's back here from the break.
Coming up, it's a bling thing? Find out if this jeweler is solid as a rock. Next.
Back in mid-September, we had a great quarter from Signet Jewelers. That's the parent of Kay, Zales, Jared, Blue Nile, and several other jewelry brands. But today we learned that longtime CEO Gina Drozos will be stepping down. And I am sad to see her go, because she's one of the best in the business. Clearly, I'm not alone. Stock did plunge nearly 8% today. So what do we do now with the stock? With its turnaround, our CEO is planning to retire in November. Let's go straight to the source with Gina Droso. She's the outgoing CEO of Signet Jewelers. Gina, welcome back to Mad Money.
Thanks, Jim. It's great to be with you.
Well, look, it is bittersweet. I think that we must celebrate someone like you, because when you came in and we did go out to lunch, and I remember I said, why are you taking this godforsaken job? And you told me that you knew you could turn around, and you did. How'd you do it?
You know, I had spent 5 years on the board of directors before I came in as the CEO, where I've now been for a little bit more than 7. And I saw the brilliance in the team. This is a team with great expertise, with passion, who was ready to drive change. And together, we've transformed this company strategically, financially, and culturally. I never could have done something like that on my own. I've done it with the support of the entire Signet team. So I saw that from my vantage point at the board level and was excited to come in and lead that charge among the team.
All right, well, I'm going to go back to 7 and 8 years ago, Washington Post, and I told you these when you took the job. I said, wait a second, 8 years ago, it was current day then. Is Signet a diamond empire or a finance company? I was saying maybe you were going for a pawnbroker job. And then hundreds alleged, and this is a tough one, sex harassment, discrimination at Kay and Jared Jewelry Company. That's from 2017. You did a root and branch turn at this company.
It's really exciting to see where the company is today, Jim. We're an entirely different company from where we were 7 or even 12 years ago. Strategically, we've invested to create a dynamic portfolio of retail brands. We know, based on our data, that these brands, you know, from Kay to Jared to Zales to Blue Nile, appeal to 80% of jewelry customers, but we only have a 9% market share. That's up about 50% during our transformation, with a lot of headroom for growth. So we're excited about that. Financially, we've invested in the important things in the business, in services, in digital presence, e-commerce up 4 times. So really a great story there. And then culturally, we're an agile and innovative team of diverse thinkers. People come to work at Signet every day and bring their best ideas, and that's what we see in the results.
But you also told me when you took the job, look, I got to first fix the balance sheet. How's the balance sheet versus when you came in?
Well, the balance sheet is in great shape. We've been able to more than double liquidity. Our debt is at a very, very healthy place, our leverage ratios. So we feel great about what we've been able to do on that front, but we feel even better about what that's enabled us to do. We've been able to invest in stores. We've invested in our people. We've invested in a lot of those capabilities in digital and data I was just talking about. And those investments are not in any way exhausted. There's a lot more juice to squeeze from those. So I'm very excited for the momentum in the business and the trajectory and brilliant future Signet has ahead.
All right, so tell us about your successor.
Yes. So I've been in discussion with our board of directors for more than a year about my eventual retirement. It's been a very disciplined, governance-led process. They were having meetings, and I was participating in developing the criteria that we were looking for, for more than a year. And we really wanted someone who was a retail expert. And J.K. Samancic, who's coming in behind me, has more than 30 years of retail experience across a number of different companies. We wanted someone who had a track record of leading growth, which he does in multiple environments. We wanted someone who knew how to leverage these investments like services, loyalty, our CRM capabilities, which he does. And we wanted someone who would both preserve and grow our culture. And he has a great track record on all those fronts.
But we also know that you gave people a 562% total return for Signet. And that's going to be very big shoes to fill, frankly, Jen.
Well, you know what? A company is certainly not one person, and this transformation has been broadly led. I believe that I have built one of the very strongest teams in all of retail, and they are ready to welcome JK in. They bring a lot of expertise in our industry, and he'll bring some fresh thinking. Change is great for driving results.
And my colleague, Carl Quintanilla, wanted me to ask you, where are we in the engagement boom?
It's coming back. We have been predicting that based on COVID, there would be a lull followed by a 3-year tailwind. We have begun to see that tailwind kick in already. We just announced our earnings a couple of weeks ago, reaffirmed our annual guide, are seeing a strong back half to our year. And a part of that, for sure, is the inflection point that we've seen in engagements. All of our external and internal data says that 3-year tailwind has now begun.
Well, look, I want to congratulate you for what job you've done for shareholders. I'm going to wish you all the success in the world. You have done just a remarkable turn for a very storied company. Gina Droso, CEO of Signet Jewelers. Best of luck. Best of luck in your next career or whatever you'd like to do.
All right. Well, thank you so much. I appreciate it.
Mad Money's back after the break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the lightning round. We're about to go close to the same name. It's started by social speaker. No, the core stock budget. My staff principal. We're going to play the sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Steve in Virginia. Steve.
Yes, sir. This is a true honor to speak with Jim Cramer. I've truly enjoyed watching your show since the days of Tudlow and Kramer.
You are too kind.
I'm also a member of the club.
Oh, really? Thank you. I really appreciate that. Let's go to work.
Yes, sir. So my stock symbol that I'm interested in is NNE for nanonuclear energy.
I'm aware of it. Let's just be honest. That company loses a lot of money. We got GE Vernova. If nuclear energy is really going to come back, they do small form reactors, and that's going to be the place to be. Let's go to Stephen in Louisiana. Stephen.
Hey, big booyah from Shreveport. Jim,
I love Shreveport.
Oh, yeah, I can't laissez les bon temps rouler down here because of McKesson. MCK. That thing's been kicked around like a football in Tiger Stadium.
And it's time to buy it. It's time to buy it. They're not just a middleman. They do a lot of good things, and I think the stock has had a way too big a hit. It's now selling at a below-market multiple. I'm ready to start buying. Don't buy all at once. Buy in a pyramid style. Buy your first one to 100, do 25 here, and then wait for it to come lower. Truman in California. Truman.
It's been a while, Jimmy. Good Rosh Hashanah to you.
Oh, same to you, and thank you so much, and to your family. How can I help?
Thank you. And shout out to my little triplet nieces on their birthday, Luca, Luna, and down to business.
Well, you're a lucky fella. Thank you.
I'm laser focused on data center energy suppliers. My basic thesis says it lends itself to say natural gas is the most likely supplier for data centers, as nuclear is great, but it's going to take so long and so much regulation to overcome. Data centers need that energy 24/7, 365, and with consistency. I'm looking at a product mix or a pure play natural gas exposure in the U.S., trying to find a heavy natural gas producer at a reasonable price per MMBTU with a viable risk reward.
All right.
I'm looking at FANG, Diamondback. What do you?
Diamondback's a little too much oil for me. We bought Coterra, CTRA. That's the old Capital Oil and Gas. And we think that that's better when we bought it for the club today, and I think that you'd be better placed doing that one. And thank you for the great well-wishers. Let's go to well-wishings. Let's go to Jonathan, Pennsylvania. Jonathan.
A big Bucks County booyah to you, Jim.
Well, I'll be there soon enough. How you doing?
I'm good, man. Hey, when you're here, I'll meet you at McCool's in Quakertown, buy you dinner and a beer. Thank you for all the priceless education you've given me.
I went with a bunch of buddies to McCool's last year. You had a good call. How can I help?
Hey, that's a good place. Jim, the company I'm calling about is a little pricey, and their return on equity is a little bit below their industry average. I'm wondering if it's a problem that their return on equity is a little bit below average. Do you think that's a problem for Little Fuse, LFUS?
Well, I think it's not so much return on equity. It's that, frankly, it's got a huge multiple for its growth rate, and that is worrisome to me. I'm going to have to say we got to come back with something that is less expensive. Let's go to Jerry in New Jersey. Jerry.
Oh, hi, Jim. I have a question on Archer Daniels Midland as a long-term investment, not as a short-term catalyst. I know they're facing a lot of complex challenges and so forth that have been discussed in the financial media, and that they could be construed as a value trap. However, there are some opportunities I see in terms of it being at a 2-year low, and it could be an
but you know what, Jerry? I hate to say it because we're both Jerseyans, but I think it is a value trap. It's been there forever. I can't put you in that one. We got to get something with a little bit more growth, but thank you for the call. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
At the top of the show, I went over the biggest winners of this remarkable third quarter, and they were surprisingly obscure. It was a motley crew of 10 stocks that had more to do with power generation and rate cuts than the Magnificent Seven or the old FANG. We don't have any famous, fast-growing medical companies or cybersecurity juggernauts, many of which have been taken to a newfound, hitherto undisclosed location, the woodshed. You know where I'm finding these stocks, though? How about dead last? That's right. You want to find a bunch of former market darlings? I want you to take a look at the bottom of the S&P 500 for this quarter. In fact, the S&P component that finished dead last for the quarter, down 49%, was none other than Supermicro Computer, a partner of NVIDIA that's integral to the data center plumbing we need for artificial intelligence. There's some delicious irony here. Investors have spent so much time thinking that if they just close their eyes and select something related to AI, it'll hit a home run. This last quarter demonstrated that if you back the wrong AI horse, it could really send you straight to the glue factory. And look, Supermicro is a good company, even if its stock went to insane levels earlier this year. But if this stock market's going to have a long-lasting move, well, guess what? It needs to be powered by new stocks, not the old leaders that are clustered around AI and thrive on now exhausted momentum. Don't get me wrong. I still believe in AI, and I still very much believe in NVIDIA. I always say, own it, don't trade it. And I'm sticking with that, even as I see it's being dumped all over the place. I'm not blind. In fact, I think NVIDIA could have a very big year in 2025, even as I suspect that the near-term weakness can continue. But you can no longer afford to just go on autopilot with Magnificent Seven and forget about everything else. Those days are now over. Those stocks had enormous moves earlier in the year, and it's time for fresh blood to drive us to new highs. How about high-growth medical stocks? Now, there's a huge cohort of money managers who they love these things, right? But classic growth stocks like Moderna, down nearly 44% in the third quarter. Medical device maker Dexcom, down roughly 41%. Moderna simply hasn't been able to follow up with its game-changing COVID vaccine with anything big enough to move the needle. Dexcom practically printed money for years with its blood sugar monitors, essential for people with diabetes. Now, though, Abbott's got a cheaper version that's selling very well, and shareholders are worried that the GLP-1 weight loss drugs will ultimately shrink Dexcom's total addressable market. And here's something very telling. I got to tell you, the fourth and fifth worst performers SP, Dollar General and Dollar Tree. At the beginning of the quarter, we had sky-high interest rates and a cash-strapped consumer. Isn't that usually good news for the dollar stores? But not this time. They now got some real issues. One, thanks to inflation, it's been very hard for them to price things at $1. Two, you're supposed to dump the dollar stores when the economy turns around. That generally happens if the Fed starts cutting interest rates. And three, and most important, the dollar stores have become victims of smarter shoppers who know they can get better bargains from, say, Walmart. Remember, Walmart rolled back prices on thousands of items in the last couple of months, sowing the seeds of destruction for the whole dollar store complex. Dollar General and Dollar Tree certainly haven't distinguished themselves as real bargains when it comes to their stocks or their merchandise. One thing's certain. Wall Street, the complex of analysts, money managers, corporate finance, traders, they missed out big this quarter, didn't they? They still act like the new losers will be winners soon enough, while the new winners are all one-hit wonders. I say, dream on. This move could be here to stay. I like to say there's always bull market somewhere. Prime time to find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.